Welcome to Around the Coin podcast. Today's guest is Eric Shoykhet, the CEO and founder of Link Money. Link Money has raised over $30 million to date, building out pay-by-bank infrastructure for merchants. So for mid to large scale, over $100 million revenue businesses that want to minimize the transaction cost to accept payments from customers, moving away from credit cards, Link Money is an option. They connect directly to your bank account and allow customers, to pay direct to merchants. This trend is happening all over the world outside the United States, and Eric and his team at Link Money are bringing this into the US. We talked in the first half of the podcast about the investment landscape, what's happening in the world. We discussed some of the psychological patterns and market patterns of investing and macroeconomics. Eric previously was an investor at Governor's Lane, a hedge fund. We talked about why he started Link Money, why he moved out of hedge fund investing, what he's learned so far at Link, and what the different layers of the tech stack in banking are, which I found really interesting. Hope you enjoy this conversation. If you do, please give us a thumbs up or like, share wherever you're listening to it, and hope you enjoy. Here is Eric. All right, Eric, thanks for hopping on. I'm excited to dive in with you. Why don't we just dive right into the deep end on this one? So a few minutes ago, we were talking about your background and just the view of the market in general, and the market being, let's define it as early stage funding in maybe fintech, maybe more broadly. How do you sort of view where we are today? We're recording this for listeners early March 6, 2023, for context. How do you sort of see our trajectory and funding cycle for startups?
Yeah, so I think if you take a long-term kind of zoomed out view of what's happened since the financial crisis, we've basically had a extremely large asset bubble, which was driven by basically quantitative easing and 0% interest rates. And if you look back, we had effectively, really since the financial crisis, we've had basically 0% interest rates for a super extended period of time. Rates were starting to normalize in 2018, and then the Fed kind of got a little scared. And then obviously we had COVID, and COVID led unprecedented quantitative easing plus unprecedented fiscal stimulus, which led to a combination of animal spirits that resulted in an insane blow off top in 2021, which resulted in a wild amount of uneconomic business models getting a wild amount of funding, completely unprecedented. And this isn't just about venture capital. If you take a zoomed out view, this has affected every asset class. So if you look at real estate, you had people doing Airbnb roll-ups and multifamily and all these kinds of crazy things to get 4 to 5% yields. When now, if I just check my screen, the 1-year government bond is over 5%. So what does that mean? So it means you can sit on your butt and do absolutely nothing, not take any duration risk, and get 5% yield from the government guaranteed. So that's going to completely reset all asset classes: real estate, venture capital, private equity. Though the stock market hasn't really gone down a lot yet, I think, we'll see. But I think it's going to completely change the paradigm. And so I think about it, if you think about it from a venture capital perspective, a lot of the quality businesses that got funded post financial crisis, especially in the kind of call it 2010 to 2013 context, were, decent quality companies, often marketplaces, where the unit economics made a lot of sense, and they had to raise in a down market. And so they built fundamentally stronger businesses with better unit economics. And this went from, some high quality platforms, let's say like Airbnb as an example, but pretty high quality business that, still probably is overstaffed and has too much cost, but like the fundamental unit economics of the business are really good. To 2021, when we ended up with, 25 food delivery companies that were doing negative 70%, gross margins, that were 6 months old, raising $1 billion and basically pissing away all the money and giving it away to customers. And so that was the life cycle. That's over. All the funds that were, I'd say very simply, any round that was done in 2021, if it is a mediocre company, is, going to end up down probably 70 to 80%. If it's a bad company, it's going to be a 0. And if it's a good company, it should be down probably 50 to 60%. And that's just based on, if you pull up, nonprofit, or should I say, unprofitable tech or speculative SPAC type companies or other similar companies on public markets. So you pull up something like ARK, which is an ETF of loss making or not super high quality, generally software companies or speculative software companies, it's down 70, 80% from plan. Things that are worse are down 90. You look at something like Carvana, it's down like 95. It's something that's higher quality, like an Adyen, which I'd say is probably one of the highest quality businesses in payments and / software. It's down 50. So just, being super disciplined and just doing that basic analysis, that's the reality. And so this hangover is going to last a long time. You have a lot of VC funds that obviously raised huge amounts of money in 2021 off of these fake marks that generally weren't really, a lot of it wasn't realized. And so these guys are all sitting on a lot of dry powder. And so I think there's this view that basically, because there's all this dry powder out there, that's going to offset this down cycle and make it more palatable. I don't think that's true. There's examples from the tech bubble where there was, plenty of funds that had been raised. And basically what ended up happening is these funds just got deployed over a much, much longer time period. Instead of funds getting deployed within a year or two, which is what was happening recently. The best example probably being Tiger, which deployed, a fund in like 6 months at the top, or SoftBank. Those funds are going to get deployed now over 4 to 5 years. And so the cadence of deployment is going to be much, much slower. And so because of that, and because of what's happening in public markets, and because of what's happening with the normalization of interest rates and potentially a recession, we'll see either way. But I don't think it really matters if there's a recession. I think the normalization that's going to happen in venture capital and the reset in valuations is going to be kind of a multi-year process, as it always has been, as it was in the tech bubble, as it was in post-financial crisis, that probably lasts 3 to 5 years, let's say, or 2 to 5 years, if you want like a huge confidence interval. And valuations will go down again, on average, 70% peak to trough or 80% peak to trough. And the companies that will get funded at this point are going to be higher quality companies that are solving acute pain points where the unit economics fundamentally make sense. And they'll do it at valuations that even at this point are good, but they're going to be down dramatically from the peak of 2021.
And if I'm sort of distilling this down to the crux of the cause of this, and I even hesitate to use the word cause because nothing is independently caused by it, but do you view the interest rate and the centralized monetary policy as being the influencer over the amplitude of the rise and the crash? I mean, this certainly there are trends and patterns to boom and bust cycles, but they seem to be amplified given the monetary policies at the time. Is that your view? Is that this was just poorly managed from a Federal Reserve perspective, and that created so much capital and low interest rates in the market, and kind of fed the animal mind, as you say? Fed the animal thirst. Short answer, 1,000% yes. I mean, it's actually kind of insane, but if you take like that, this is even like a mystery. But if you just zoom out, if I told you the risk free, meaning your fundamental cost of capital in the market is 0%, you're going to be like, okay. Well, basically, you're telling me that everything I do that generates a return makes sense, potentially, because you're telling me the cost of capital is 0, right? You just zoom out. That's like, for 15 years, the government basically told us the cost of capital, even if you look at, that was the short term, obviously, Fed funds rate. If you look out at what the 10-year bond was, which is probably the more fair way to look at it, okay, but it was still like 2%, 2.5%, whatever the 10-year was before the recent move for the last year and a half. So basically 0, right? You're looking at 10 years and you're barely getting any yield. And so what that signals to the market is basically go deploy capital in anything that's kind of above that. And if you get some modest compensation for your risk, that makes sense. And that's basically what happened again in every single asset class: stocks, real estate, VC, art. Like, you think it's an accident that crypto just came out of nowhere with, post, in this recent period? It's not an accident. So you have like fake coins that have no purpose or no actual use case that have tens of billions or hundreds of billions of market cap. So it's not an accident. And I think what ended up happening was, because of that, and zooming it back down to VC, huge amounts of capital got attracted to the space. And when huge amounts of capital get attracted to a space, future returns suck. It's just the axiom of finance. Right. Huge amount of capital chasing limited amounts of opportunities. Your forward returns on deployment are going to be right. So by definition, that peaked in 2021 with huge amounts of capital chasing a lot of companies, a lot of which were, full of that. It was a bad pawns, a lot of adverse selection. And so the forward returns of capital deployed in 2021 are going to be really, really probably the worst they've been in, since the tech bubble. And so,
that's not different. I come from a public markets background and I've spent time in a bunch of spaces, including like oil and gas. You can look this up, but the 2014 to 2021 oil bear market really sounds a lot like what's going to happen to tech. Basically, 2014 oil prices crashed because basically shale really started to scale up, and a bunch of these publicly traded shale companies attracted huge amounts of capital, and same in the private companies, because they were telling all these investors that the forward returns on drilling wells in the Permian and Eagle Ford and these places in Texas were really, really attractive. 50% IRRs left and right. You can spit in Texas and get a 50% IRR. And so huge amounts of capital came into the space, high yields, bonds, equity, PE, all these sorts of things. And there was tons and tons of drilling. And what happens? Too much capital, too much drilling, too much supply of oil prices crashed. They went from, $100 a barrel to, in COVID, they went negative actually, but like call it $20 to $30 a barrel. And so there's been a huge reset, huge multi-year bankruptcy cycle. All of these publicly traded oil companies have had to transition from a growth-only mindset, basically grow at all costs, drill, to a return on invested capital mindset. What's our cost structure look like? Are we deploying capital responsibly? Let's cut our cost structure. And this was like a 7 or 8 year bear market. And it's not an accident that last year, the best performing sector in the public markets was actually oil and gas. And by the way, oil prices were actually not up last year. By the way, they peaked at one point post the Russian invasion, but actually oil prices were pretty much flat last year. Yet oil and gas stocks were up a ton. Why? Because they rationalized their cost structure and actually, profits have done very, very well. And so that's probably what's going to happen in tech. You're going to have a multi-year period where companies are redesigning their cost base, look at their cost structure, thinking about whether they're deploying capital in a rational way, and moving from a growth at all costs mindset to a mindset of growth at reasonable costs with unit economics that make sense. And it's not an accident. Again, you see like Salesforce, good example, the other week, like reported good earnings. It's really cost, but they have like 10 activists, not 10, there's like 5 that are, activists on Salesforce telling them to realign their cost structure. And Salesforce is a really good sticky software product. And so they'll be able to do that. But this migration from grow at all costs to disciplined capital deployment and having a responsible cost structure, it's really painful. And you don't necessarily want to be around and own these stocks for that period or these private companies. If you look at what happened in oil and gas, it was really painful, 7, 8 years, defaults, companies going bankrupt, stocks did not do well. And so it's going to be a long and painful reset.
And so it seems like it's a combination of both the centralized monetary policy, but in your example there with oil and gas, that didn't seem to be a influence or a cause of a monetary policy. That was just human beings getting very excited about an opportunity. And in that moment, this animal spirit kicks in and they misprice future earnings. They get greedy effectively, right? I mean, is that how given that we're fairly close to the tech collapse, and the farther that we get away, the harder it is to remember how we felt in those moments, because everyone is excited about NFTs and all the things that are growing. And there's I was talking to a hedge fund manager in healthcare. So he's managing very completely orthogonal to NFT and crypto. And he's getting pressure to invest in things that are just way outside of the bubble of what he's typically investing in. And he's feeling depressed. He's like, man, I'm flatlining, I'm not growing, and everyone else it's like a gold rush is happening across the street and you're sitting there, boiling water. Do you feel like there's a real lesson? How do you view the lesson that people can pull from this, given that they've just lived it, and not make the same mistake again? And maybe even on a personal level,
it's inevitable that this will happen again in both in tech and in other asset classes, because this is just how markets work. But what I would say is tech was a unique combination of, the example in oil and gas was much more idiosyncratic, but it was still in the backdrop of low interest rates. I think tech was the epitome of basically both, because tech by definition, tech companies or unprofitable companies, all your cash flows are far out in the future. It's just definitional, right? A lot of these companies, you're growing really fast now. At some point, you'll make cash flow in the future. And so they're long duration assets. And so in an environment that has artificially suppressed long-term interest rates, the assets that get most bubbly are long duration assets, which is tech. So it's inevitable that monetary policy that was probably inconsistent with where it should be showed up or led to the largest bubble manifesting was tech. That's not an accident. Then you added COVID, which there was a fundamental piece to this. So the fundamental piece to this was effectively, post-COVID, e-commerce went from, 10% to, or 12% to at one point, I think in the low 20s, 22%, call it. And the market and VCs and everyone basically concluded that all COVID did was pull forward a decade of e-commerce secular growth and software entrenchment and things like that. And that was going to be the permanent new base of market penetration. And then everything was going to compound from there. That was like if you go pull equity research notes or go talk to VCs circa, post-COVID and especially, late 2020, early 2021, mid 2021, that was the consensus. And so that started with, this going up, 20x and having a larger, I still remember it's like September, I think of 2020, or maybe it was a little earlier. Maybe it was like June of 2020. Someone can fact check me on this. When Zoom market cap exceeded ExxonMobil, and that actually was the peak for Zoom. And since then, Zoom is down, 90%, and Exxon is like 3%. So the point is, it started with, people saying, okay, everyone's just going to sit at home all day and Zoom all the time. And Zoom is the dominant platform. It's the Facebook of, teleconferencing or whatever. And, this should be a $300 billion company. And then it went to e-commerce. So, you look at companies like Shopify, you look at Amazon, you look at other, streaming services, Netflix, Fubo, whatever, all these other things, software companies. There's this view that basically COVID just pulled tech adoption forward by 10 years. That was completely wrong. E-commerce went right back to basically on trend, completely normalized. If anything, it seems like, all COVID did, which makes sense, was create a lot of pent-up demand for real world services. I know I don't know about you, I go to restaurants around in Miami and everything's packed and insane and hotels are insane and flights are insane. So actually those are still the strongest areas of the economy because I think we're trying to offset the year or two they think they lost. And so it did increase adoption in certain software areas. It definitely, has changed, work from home habits and things like that, but it didn't really increase tech adoption or software adoption, e-commerce adoption anywhere near what the market had underwritten by the middle of 2021. And so that's what everyone just totally got wrong. And if you then pull up a graph of earnings expectations for Amazon or Shopify or Netflix or Zoom, you'll see they've come down people's estimates for this year and next year earnings are down very, very, very dramatically from what people thought in 2021, probably like 80%.
Yeah.
And so that's really just the combination of that fundamental incorrect thesis, plus the fact that, again, tech is by definition the longest duration asset. And so it was most impacted by the artificially low interest rates we had through kind of, call it middle of 2021, before people realized that inflation was actually a huge issue that was about to brew up.
So I'm most interested in this narrative of what's the cause of most people being wrong? You think in a democratic society, we have this backbone fundamental idea that if the best way to find truth is market demand, like whether it's a stock or whether it's voting for a politician, we put it out to the masses and then the market, it goes back to like Adam Smith, right? It's like the market will bubble up the true price of something. And there's a truth to that, but there's also seems to be like a massive exploit or a vulnerability in how people think. And I tend to think, tell me what you think of this, is that it's an individual, if an individual is making an assessment of, say, a stock or a company, that if you have a million people making a million independent decisions, then you get to the closest form of truth you could get, assuming those people put in actual work to make that conclusion. However, the market is more transparent than that. You can see the other, 900,099 people. So you can see everyone else in the market making the decisions real time, given the price. And so people take a shortcut, right? If you're like the last person in line, well, why bother if everyone else is already concluded? But the reality is that there's a balancing game between who's actually doing the work to evaluate companies and who's just piggybacking on everyone else. And there's not a real way to determine that. I mean, you see the price, but there's like, how do you know if everyone is putting in the work? And when everyone is looking at everyone else, and what their test results are, and no one's actually putting in the work to evaluate whether it's a real estate property or an investment in some company, then that's where the train gets like far, far off the rails. And then it course corrects because reality always hits. Does that resonate with you? I mean, when you think about like individuals making the decisions, like same thing in voting, right? It's like go out and vote and there's peer pressure just to say this is the right answer. versus like, okay, you have to do actual individual work to conclude what the best answer is?
Yeah, I think, look, markets are generally right and intelligent over time, right? But no one guarantees that that time is, today or 6 months, right? So I would say the market, I'm a strong, if you participate in public markets and you believe that markets anchor to valuation and fundamentals over time, as I do, then by definition, you have to believe that they sort themselves out over time, which I do. But again, over time can mean a long period of time.
Yeah.
Right. You look at the housing bubble, right? That really kind of went on, really started cropping up, I would say, like shoddy lending schedule, let's say in like 02 or 03, right? So that was like a 6-year type ordeal. This, I think, kind of overvaluation tech has really been brewing since like probably 2018. So, and if you go back and look at some of the bubbles in, let's say, commercial real estate and things like that, this has been going on since like probably 2014 or 2015. So these things can take a while, but I do think the markets are really good over time. When they wake up quickly. Like you've seen, the revaluation in unprofitable tech companies in public markets has been absolutely savage. Really, these things went down like 80, 90% in like 6 to 9 months. So when the market wakes up and switches its paradigm, the change can be very, very fast. Now, when it's going to decide to switch that paradigm, it's harder to assess. But I think markets do a really good job over time. And then the other thing I would say is, if you look at other asset classes, we take venture capital as an example, there's structural inefficiencies embedded in the market. And what I mean by that is, so in venture capital as an example, your risk reward of, being a GP and running a fund, when everyone's deploying money, let's say into crypto or grocery delivery apps or whatever it is in 2021. So if you don't deploy and you don't participate and you're like, I'm smarter and this is all zero and this is going to blow up, well, you're going to get a lot of pressure from your LPs. And if these people are right and everyone's involved and you're the one person who's not, then you have a real problem. Then you have a benchmarking issue, right? Then the benchmark is up a lot on all of these deals and you didn't participate and you're the one fund in the crowd that didn't, and so you're going to look really bad. So it's kind of one of those situations where if you do participate and everyone kind of sinks with the ship, well, then you could just be like, well, look, every other fund deployed into stupid shit in 2021. And I also was an idiot, but whatever.
Right.
Everyone else, and then you make up some narrative that you were slightly less dumb than everyone else and you deployed a little bit less into the worst stuff where you didn't deploy as much. And then, so therefore we're better than the other ones and you should invest in us. And that, by the way, that narrative happens all the time. It's true, by the way, in public markets too. It's the same reason. Like if you're a fund and you were down last year, right? And the market's up this year, you can't afford to be up less than the market this year, right? You have to chase because then like if the market kind of goes back, then you look really stupid. Oh, you underperformed the market last year. Now you're underperforming again, right? So it's tough to be like, hey, I think the market's really overvalued and it's going to come down over time and I'm okay missing this short-term performance. It's tough. You get pressure from your LPs. And so in a lot of cases, this is true in public markets, it's true in VC. It's better to just kind of go with the crowd and sync together. And if everyone loses money, whatever, everyone loses money because you don't look as bad. But it's much worse to miss out and be the only one who's not making money, even if that could potentially bring the word of you're the person who doesn't lose money when things go south.
Yeah. So effectively, you're bringing up this idea of like a social price, right? You have the actual price of the company and you have the price of me not making the correct decision when everyone else made the correct decision or decision that.
Well, you're thinking it's you thinking as an individual actor, as a business owner of your fund or, a manager of your fund, and your incentives and your personal risk reward and the risk reward of the fund as a business is fundamentally very different from the risk reward of your LPs potentially, depending on who they are. Right. And this is true. I was in the hedge fund industry before this, like, if you think about, what makes sense for the fund as a business. And if you're trying to optimize the business versus like actually putting up returns, they may or may not be, often they're not the same thing. So that's true in venture capital. It's true in hedge funds. It's kind of true everywhere. And so there's, you're not doing a bad, I mean, you should be thinking to kind of probably optimize the returns of your investors and put up the best numbers. But the reality is, you're thinking about it as a rational actor and you just have really different incentives.
Yeah. Cause even your investors, they don't just want the highest absolute rate of return. They want a slightly better return than everyone else. Even if everyone else is down and you're slightly less down, maybe they're happy. And you're really optimizing for their happiness, right? Because if they're happy, then there's a slight difference.
Exactly. This is like, what you just said is completely right. It's basically some weird matrix of they care about absolute returns on to some extent, but they also care a lot about relative returns. And so like they would trade off probably having slightly worse absolute returns if it meant like they looked better on a relative basis. Because remember, the LPs themselves, let's say it's an endowment, they get benchmarked versus their peers, right? Everyone goes, okay, this endowment was up. Let's say the endowment was up 20% for the year. You'd say on an absolute basis, that's fantastic. Like markets go up 6-7% a year on average, like 20 is amazing. Oh, but this other university was up 27. So we look bad, right? It's like life. It's like everything.
Yeah,
personal. Yeah, it's a comparative game. So the the institutions themselves, the LPs themselves also have a weird kind of incentive structure that's, again, not everyone's aligned on really, or I should say most people are not aligned on putting up the best kind of absolute returns.
Okay. So tell me this. So recently, AI has been the talk of the town, and the AI has typically been looked at through the lens of creative work. Like there's DALL-E that's creating beautiful works of art visually. There's all sorts of amazing text that's using large language models. Do you view what we've been talking about so far as kind of these like human heuristics that people get caught up in these emotional games? There's differences between the actual rate of return and what they're actually optimizing for, which might be, like we're talking about relative rate of return of other portfolios. Do you view that maybe this is already happening? I don't know, but could you take into account using a AI model that takes into account all the communication that's happening on the internet with like Twitter, and it's looking at the different prices of oil and all the other exchanges of all the other countries and looking at past data, and it's aggregating all the world's financial and social economic data together. And it's saying, hey, I think we're in a bubble in the automotive industry, or we're underpriced in this or that. Do you think that'll emerge as people will look back 30 years from now and say, wow, hedge fund managers were making decisions just sitting around a table? Like it'll look kind of primitive, or do you think that's overstated?
I don't think so, because I think the reason people get paid, or I should say, the reason people who put up really good long-term track records have put up really good long-term track records, look at Buffett as an example, it's not because they're smarter. I think it's a false notion in investing. I think you don't have to, in many cases, to be a good investor, it's not about being that smart. The basic arithmetic of thinking about a multiple on earnings is math a second grader can do. Even a DCF, sure, you're taking the long-term approach is not that complicated. So it's not about that. It's not about being better at math or better at data analysis or having, yes, it's important to have good information, but a lot of times that, with the internet and a lot of services out there, a lot of that data is already accessible. So it's not really about that. You actually get paid, I think, for a few different reasons in investing. One is, and one of the ones Buffett would talk about, and I think one of the best forms of earning, alpha or excess returns in markets is duration arbitrage, meaning you just fundamentally have a longer time period than the market. The market is now down, this is a crazy stat, but basically half of all options activity now is 0-day options, meaning options that expire today. So effectively gambling. Okay. So that's the current state of the stock market in terms of behavior and duration. So if you could take a 5 or 10 year view on a company, the market may not be willing to ascribe value to certain pieces of that business or think about the business in a certain way, that if you have a bit longer of a time horizon, you can. And that's how Buffett, in a lot of ways, made a lot of his money, right? He's taking a longer time perspective on some of these businesses. Maybe they're cyclical, maybe they're going through a secular change, whatever. And he's appreciating, that they're fundamentally strong businesses in a way that the market's not, because he has a longer time horizon. So that's a great way to get paid. Another one is just kind of pain tolerance and the ability to resist getting caught up in price action, right? Like, give you an example right now, and we can revisit this in a year. Right now, basically the yield on the S&P and for sure the yield on the NASDAQ, so what companies are earning as a percent of their market cap, is less than the 1 and 2 year bond. Okay. Right. The 1 year bond is over 5%. The S&P earnings yield right now on current run rate earnings is probably about that on declining earnings. And I know for a fact on the NASDAQ, it's meaningfully less than that. So right now you can earn a higher yield just giving your money to the government, totally risk-free, than you can owning stocks, which right now have basically declining earnings and probably, I would argue, the worst fundamental picture in terms of margin reset and kind of demand picture and interest rates going up and all these sorts of things. Probably worst picture they've had in a decade, potentially. So is that right or not? I don't know. But people, the reason people, a lot of times will not sell stocks and go buy bonds is because they need to be involved in the market, or like markets move a lot. So like, you can have a period where the market goes up 5-6% in a week. And yes, if you sell, you made 5-6%. So there's a lot of these other, dynamics, that you get paid for. I think, duration, arbitrage, ability to have pain tolerance and not get FOMO'd is another great way for like investors. If you look at the track records they put up, in order to be able to put up the, good numbers, you need to have and be able to sustain periods where you look wrong and you don't get FOMO'd, right? Because you wake up every day and the market price is doing what you don't think or what you don't think it should do. And you have to say, I think this is incorrect, and resist, right? And so I think this is a long-winded way of saying it's not about AI and being smarter. The reason, if you decompose the reason good investors, put up really good long-term track records, it's not because they were smarter or they had necessarily better information. It's really about these other facets of being able to, have a different or longer-term perspective than the market, which I don't think AI, again, AI can maybe make that recommendation, right? But the human has to actually act on it, right?
Yeah.
At the end of the day, that's the key piece of the puzzle is really that.
The human has to trust that the AI will perform better. And right now, that's what it seems to come down to. Most people would trust in either it's an ETF or a hedge fund manager.
Yeah. But I'll give you an example. I'll give you I'll give you a really easy example. Okay, let's run back to 2021. Let's say I had an AI and I asked him, hey, I could probably go into ChatGPT and ask you this. Do you think food delivery is a good business model? And if ChatGPT is decently smart, and maybe it is, it's going to say, hey, Eric, no, it's not, because in 2001, Cosmo tried to do food delivery out of a van and the company was a zero and it's never worked. And, selling sushi for $20 and dropping it off at someone's apartment when the minimum wage in a lot of these states is $15 to $20 an hour and you don't have density and the customers aren't that repeat and there's 10 different competitive apps. This is not a good business model. Okay. The AI is going to tell me it's not a good business model. But then all my VC buddies are deploying hundreds of millions of dollars into food delivery apps. And so now what do? I have FOMO. My LPs are saying, oh, this is a hot new space. Why aren't you doing anything in it? I'm like, oh my God, what if it's working this time? The AI is wrong. They figured out the model. It's actually going to work. And now if I'm not involved, I'm screwed because I'm going to be the only fund that's not in food delivery. So how good is your AI then? Right. It depends on the person. Right.
Yeah.
And that's like something like, again, I think most people are, who, a lot of these investors have, fancy pedigrees and good backgrounds, and they're pretty smart people. And I think anyone, like, if you just showed them, if we zoomed out of the situation and I just showed you the unit economics of food delivery and I explained the business to you, I didn't tell you what it is, I think you would say, this does not sound like a good business. If you had to rate on 1 to 10 scale, you'd be like, this sounds like a 2.
Yeah. And maybe that makes sense. Maybe it makes sense to the individual, even if they know that it's going to like maybe it's like, hey, for my 24-year-old resume, raising $15 million, building this company for 3 years, and then it's going to crash into a wall as the market collapses. But I'm better off as an individual. Maybe that's the reality of it. So
yeah. And also maybe as a VC, right? Because you invested early, it gets picked up a lot. It's still a lot of good hype. Maybe it ultimately fails, but that's a good notoriety for your fund. You can raise off of that if you were able to raise in that period. Yeah. And so you can actually have a situation where it's like soup to nuts, it's nothing, but you were able to raise the fund and there's a lot of good hype and press. And so, yeah. And it happens all the time, by the way. This is like, this happens every cycle.
Yeah. Yeah. Well, the question is like, does that happen? Does that become a figment of the past, given that the sophistication of the investment decisions become enhanced through, AI? I don't know, but.
No, I don't think so. Because the fundamental human nature and incentives that exist is the same in all these spaces. And that's just like, that's the axiom. That doesn't change.
Yeah, that's true. So let me ask you this. So you were working at a hedge fund, Governor's Lane for a while. It seems like you're very passionate, knowledgeable. You got good at what you're doing. You had your co-founder from Wharton that guys were pitching ideas back and forth. Did you want to start a company? Were you getting kind of bored in hedge fund land? What was the kind of impetus to start Link Money?
Yeah, I was getting a little antsy and wanted a bit of a change. Also, I'd always believed that as an investor that actually being an operator and working inside a company and seeing how a company works and actually having to build something is or could be useful as an investor. And it's like a good skill set to have and, could potentially make you a better investor. So that was always my paradigm. And I always wanted to kind of get involved in a company. I just didn't know how. And so I started my first company, Atom Finance, which was, somewhat adjacent to the hedge fund world or the finance world. It's a investment data and research platform for public markets. It was aligned with kind of my career up to that point. And, that was the first thing I started and got involved with. And I learned a lot, building that company and getting it going. And you just have to move from a mentality of observing and researching to one of bias to action. Actually having to start something from scratch is really hard. It's not an easy transition coming from a finance background. And so, did a lot of learning there. And then I started Link Money a little over a year ago on the paradigm and thesis that open banking and open banking related services would increasingly kind of exist in the United States. And the US was really far behind Europe and other places in terms of open banking and related payments. And so wanted to start a company in that space and really narrow down to our current product in market, which is a pay by bank product, which means users can pay a merchant directly from their bank account. And so what we enable via our Link Money pay by bank product is we allow merchants to accept bank account based payments from their customers. And the cost of processing for those merchants is 70 to 80% cheaper than accepting payments on cards. So it's cheaper, more secure payments, which is great for the merchant and great for the entire kind of ecosystem. So that's what we're focused on and do. And pay by bank starts really to grow really rapidly. And in markets like Europe, where this has been more prevalent for some time, it's something like 20% of digital payments.
And is the main platform e-commerce? Are you looking at in-person or both equally?
It's a mix. So we actually have a solution for in-person as well. The merchant can simply text the customer, email the customer a link to the payment flow. So it works in person as well. Our main focus is on merchants that have a payment type that is repetitive. So there's a repeat purchase from the customer to that merchant. It doesn't have to be subscription. It could just be, hey, I have a storage unit and that's on auto pay, or insurance premiums, or I go to Amazon a lot and I buy from Amazon a lot, or, I go on this ticketing platform and buy concert tickets once a quarter or whatever it is. So anything where the purchase amount is a decent size, it's not like a $5 cup of coffee, and it's more kind of repetitive. And the reason for that is those are the situations where removing cards and switching to pay via bank account can save the merchant 70 or 80%, and the dollars are really meaningful for them. So those are the kind of payment areas we focus on.
And how is that different than today if somewhere you just a debit card, which comes straight out of a checking account?
So from a merchant perspective, the way we set this up is it's a seamless UX for the customer. They literally just pick their bank, click the logo, and then either put in their user credentials or authenticate with Face ID. And it's the same as if they logged into their bank account. They do this on the first payment just once. That's it. And then it functions like a safe payment information, just like a credit or debit card would on the merchant's website or app or portal. And from a merchant perspective, we guarantee the funds and we move the money. And so for them, it's just like a card. It's the same kind of behavior that they know. The funds are guaranteed and then, processed generally next day, except it's 70 or 80% cheaper.
And did you see, Plaid has been around for a while. Is that a similar, are they targeting something slightly different?
So Plaid started really with kind of data aggregation and selling data access to bank accounts, really to fintechs. Originally, they were doing screen scraping, which we don't do. All our connections are direct OAuth connections. We don't store user credentials. It's super secure. But really, ultimately, Plaid customer base is really fintechs, and a lot of their volume and focus is on either providing this data to fintechs or doing kind of wallet or neobank account funding. That's how we do. We're a enterprise payments company with a complete merchant-driven focus. We work with merchants. The team comes from really a payments background. A lot of folks in the sales team from Adyen. We have people on the engineering and products teams from Amazon and eBay and Zelle, places like that. So we're really an enterprise payments company focused on merchants, traditional merchants, and with the sole goal really being to lower their payment processing costs and save them money.
So merchant would be like a large merchant, small, like somebody on Shopify or somebody.
Yeah, so we usually target merchants with about 100 million plus of revenue or TPV. So really enterprise. So not as much. We have some small Shopify customers, but our real focus is on merchants that are doing, hundreds of millions of revenue or payment processing. So it could be e-commerce. but also, we have partners in the remittance, because in remittances, you're sending, let's say, $1,000 a month to Mexico. So that's actually a great use case for us. That's often right now on card rails today. So it runs the gamut. It could be e-commerce. It could be quick service restaurants. It could be storage units. It could be insurance companies. Anywhere, again, where the amounts of the transactions are really, we like to focus on areas where they're ideally above like $20 to $30 per transaction, and then pretty repetitive.
Why is this? Why now? Like, is the U.S. somehow technologically stifled in like bank transactions, or is there not an incentive for customers to use it?
Yes. So the U.S. is always behind in payments because we have a more fragmented banking market, more fragmented infrastructure. So that's just par for the course. So that was definitely part of it. And the technology and ability to do this didn't exist 3 or 4 years ago. Now you can, because you can set up some of these bank account connections. It's still super hard because we do not have real-time account-to-account payments in the United States. We obviously have ACH. ACH does not settle real-time. It's a huge issue for doing something like this. Europe obviously has real-time payments. So does markets like Brazil and India. So the technology infrastructure piece, which we had to kind of get through and was not possible 3 or 4 years ago, is possible now, but is really, really challenging. You have to piece together a ton of infrastructure and build kind of a whole decision layer and a lot of technology on top of this to make it work. Unlike Europe, where you can actually, these integrations are open pretty much, and you have real-time payments. So it's much, much easier to set this up, which is why you have more of these open banking payments companies in Europe. You have still not a crazy amount. There's a few that are large and successful, but it's more competitive. September, that was the other point. And then the last piece is, the incentives. So no one really has an incentive to push this in the United States. No one's on the side of the merchant and is aligned with them fundamentally in terms of saving them money. Companies, merchant acquirers, it's nice for them to have a 10 or 15 basis point take rate amidst 2.5% or 3% total cost of processing. It's much better to have a sliver of a much bigger cost because you don't get noticed. So they don't want lower cost of processing. The banks and card issuers obviously don't, because they make money off of interchange. So they do not have an incentive to push an alternative, cheaper payment method. And so for us, this is great because every merchant for us is a new merchant. We don't work with them already. And so we have every incentive to provide cheaper payments and help the merchant save money and ultimately drive the total cost of payment processing in the US down. But the incentives are just fundamentally not there in the US in the existing payments ecosystem to want this to work. But the good news is that given the macro backdrop and everyone's focused on reducing costs and how important that is and where kind of interchange rates went, merchants, I think, finally reached a point where this has become top of mind and they understand the value prop, and the incentive to act and to want to adopt something like this now is extremely high.
Interesting. So the merchants are feeling a greater pressure financially, and so they're looking at areas where they wouldn't have typically looked at, including merchant payment processing fees. And that's why this is now top of mind for them.
Exactly. And really, I would say that there was a huge shift from, let's say, 3 or 4 years ago, where a merchant would just be like, let's just have every payment option available. It doesn't matter the cost. Apple Wallet, it doesn't matter, right? Or sorry, Apple Wallet, Apple Pay. Because the view is just like, let's just make it easy for the customer. And that mentality is totally gone. Now it's about, we need to optimize our cost structure. Growth is slowing, or unit economics don't work as well, recession, whatever it is. And hey, taking 2.5% to 3% and turning that into 1% is a huge deal. If we can cut our cost of processing 70%, pay by bank is much more secure because you're actually logging into your bank account. It's much more secure than a card, which can get stolen or used. So we actually help the merchant cut down actual fraud. In addition, bank accounts are much more stable and sticky. They don't get closed as often. They don't expire like cards. So there's less involuntary payment churn. So if we can take someone's total cost, including cost of processing plus fraud, plus involuntary payment churn from 3.5% to 1 and change percent, that's a big deal for them. And so that's really what's driving this adoption.
Interesting. And I want to learn a little bit about the layers here, the tech layer. So you have the banks themselves, which they manage probably from third-party builders, but they have their own infrastructure. And then is there a layer on top of that has made what you're doing a lot easier to integrate into? Like, is there an aggregator of banking APIs that you can then plug into? Or like, what are the layers going up all the way?
Yeah, so there's obviously the individual bank account and the data associated with that, which is controlled by the individual bank. And then there's a few a handful of data access networks in the US is what they're called, which have basically rolled up and integrated with each of these banks for API connectivity. So we have a mix of working directly with the banks and having direct linkages, as well as leveraging data access networks for the banks that aren't as large. Obviously, again, there's 10,000 plus banks and credit unions in the United States. You're not going to have direct linkages with all of them. That doesn't really work. So that is what we tap into, both our direct connections as well as the data access networks to actually pull in when you when you pass your user credentials directly through the link, the connection to the bank, and you log in basically in your bank account, we are then able to get the response and pull some of the information from your account, things like your balance and your account and routing number, which we need to actually move money. So that's the information that's fed to us. And then we take, we look at the balance in your account, the transaction, the payment amount, and we kind of make sure that you have enough money because we need to make sure that to guarantee the funds to the merchant. So we're not going to lose tons of money and have people paying for things when they don't have any money in their account. And then we use the account routing number to actually authorize and move money via ACH rails. And then there's the whole kind of infrastructure and front end component that we have to work with, the API infrastructure for the merchant to ping us, for it to integrate with the merchant's payment stack. There's obviously the front end user experience. And then there's all the back end kind of reconciliation and actual money movement that happens as well. But fundamentally, it's about customer providing access to information from their account, which enables us to pull things on balance, transaction history, account and routing number. We use that to decision the customer to make sure they have enough money for the transaction. And then ultimately, we move money via ACH rail and guarantee the funds to the merchant. And so again, despite the fact that ACH isn't real time, and there's all these issues and the infrastructure is super complicated and we have all these integrations. From a merchant perspective, there's a simple user flow with a button that says pay by bank. The user clicks it, authenticates, it's done. And the merchant just tells us how much the payment amount should be. And that's it. And so for a merchant, again, it works just like a card, except it's, 80% cheaper.
And as a company, does Link Money float that capital? So would that be money advanced to the merchant like same day or instantly? And then you raise money to float there's probably 95%, 99% completion rate on those ACH transactions. So you're basically running some model.
Yeah. So there's not that much of a timing discrepancy depending on the situation. So we can move money same day or next day or a little bit slower. That will depend on what the merchant asks us to do. If they want the money same day or next day or a few days, and then that money will flow to them. And then on the guarantee side, yes, we true up with the merchant basically consistently. So if we authorize a transaction and the money doesn't actually make it out of the customer's account because they don't have enough money or whatever else happens, obviously we provide those funds to the merchant and we make them whole. That's our guarantee. That's a huge part of the value prop to the merchant to allow them to complete the commerce and the transaction in a way that's effectively real time, even though, again, under the hood, we don't have real time payments in the United States. So that's how it works. But, generally there's not as much of a timing issue, and especially for the kind of merchants we're focused on who are large enterprises, the money coming today versus tomorrow versus isn't the huge issue necessarily. They obviously quicker settlement times, but it's really that they have certainty of funds.
Yeah. Okay. That makes sense. And then, so you looked at this and you said, there's probably a new company or couple companies out there that are that data aggregation layer. And you said maybe the market's going to go through a recessionary period, which means merchants will be trying to cut costs. And then you wanted experience personally. The other thing you mentioned was that this technology, the customer bank payments were being made outside the US. You saw that and you said this is going to happen in the US, and all those pieces came together. Are those basically all the past pieces?
I'd say that's a very good summary. I'd say the first anchoring principle was really seeing how, and I covered financials before, seeing really how pay by bank had grown so rapidly in Europe and markets like Brazil and India, and just the adoption and how that took share from cards. I think that was the bedrock pieces. And then you had to take one leap from that to say, I think eventually, at some point in the next 10 years, pay by bank is going to be a big thing in the United States. It's inevitable. It's way cheaper. Merchants are thirsty for it now, given the macro conditions. And so it's only a question of when, not if. And that was the core thesis.
Yeah.
Once you have that view, then it's more about, okay, can you actually build it? Which we didn't know.
Right.
By the way, was very unclear that we could actually pull it off and that the infrastructure was there and that we could make it a good user experience and get merchants to adopt. But the fundamental bedrock thesis of this is going to be a big thing in the United States in the next 10 years. It's an inevitability. It's really just a question of who is the dominant player pushing pay by bank in the US. That was the core kind of essential thesis. And because this isn't my first company, I think there's a lot of things I learned in terms of like picking the right market, picking the right idea, how to build the team, getting folks who've done it before and setting up the company in the right way. I think that helped a lot here to make this work better. Had this been my first company, I don't think I would have been able to do it. Candidly, I think it's too hard of a space. The go-to-market's too complicated. It takes too long to get traction. The kinds of people you need to hire are too tough, at least not for me. And I don't know if I would have been able to do it kind of as a first company.
What is it that you wouldn't have known who to hire? I mean, or you wouldn't have been able to reach out to them in some way?
I think it would have been tricky to commit. I mean, because some of the places we hire from, we have a lot of respect internally for Adyen. I think Adyen is the best example of a European payments company that's done a great job in the US. It's probably, really, honestly, the only, if you want to say it's a fintech, but really a payments company or fintech that has been successful in the United States from Europe. I actually can't name, I really can't name another one, to be honest. It's a super profitable company, much less hype than Stripe, but actually way better unit economics, a higher quality business, really based on, my understanding of the culture from the people we've hired. And I have some friends who cover the company in the public markets, like really, really well run and disciplined company. So we have the utmost respect for Adyen. And so that is why we obviously tried to hire people from Adyen. But I can tell you that hiring people from Adyen is not easy because it's a great place to work and they pay people really well and the company is successful. So I just think, hiring people from great places like we have as a first-time founder without that kind of credibility is really, really challenging. And then the other thing is getting investors to believe in the idea and give you the leeway to build out the go-to-market and get traction. I mean, it took us a year to really get traction, at least. So, because it's an enterprise payments sales cycle, it's not, you don't just show up to, a large $1 billion merchant and be like, great, add me to your checkout flow. And they're like, who the hell are you?
Yeah.
What
was your first customer? What did you have to do some kind of like sell it before you build it approach? Like, did you go out there early with a deck and start selling it, figure out customer needs and that sort of thing?
Not really, because we hired people who had built in payments before and built, not this, obviously, again, this is a new product mostly in the United States, but built similar things. And so we generally knew what the merchant requirements would be in terms of the backend infrastructure, the SDKs, the APIs, the reconciliation billing systems they would generally want. So that part we had figured out. These, specific verticals we wanted to target was a little more TBD. We had to really think about where the economics made. That's why I kept harping on larger transaction sizes, repeatability, these kinds of things, because we really spent a lot of time thinking about what are the transaction types and flows where the value prop and the economics and the savings for the merchant on the lifetime of the customer make the most sense and make this the most compelling to want to adopt today. Because, it's great if someone wants to adopt 3 years from now, but we want traction now. You know what I mean? To start growing the business. So we really thought a lot about those kinds of things. And we didn't really start pushing the product aggressively onto merchants until really it was ready for prime time. And we started with some smaller e-commerce merchants that were only doing $5, $25, $50 million of revenue. Some of them were on Shopify. And we still have those merchants and still like to add people, but that's kind of where we started to get the initial traction, make sure the products work well. Obviously, there's tons of things we still had to figure out, bugs, additional systems we need to build. So that was the process. And then we worked our way up to now having, kind of large multi-billion-dollar merchants using the product.
And so funding-wise, you guys must have raised, was it 30 million? Like, what was the first funding that you raised to build out that early product? Because I mean, you needed you needed a bunch of engineers, designers, product people to build out even that first version.
Yeah, so actually myself, Edward Landa, my co-founder, put in the first capital into the company. We funded ourselves. And then we also partnered with John Oranger, founder of Shutterstock, and on our board, who did we did the pre-seed. He did the seed, if you will. So that was the initial funding we needed to get the product going and hire some of the first key employees. And then we did a round from Tiger and Amplo and Quiet Capital. And then we did another round from Valar in the middle of last year.
And that was, what did you do? Pre-seed, seed were all before first few customers?
Yes.
Yeah. Okay.
Yeah. We had to, it's hard to sell, it's hard to have customers for this kind of products without, raising some money to build it. That's not and it takes time.
Yeah.
That's ultimately.
Yeah. No, that's why I'm most interested in these kind of businesses where there is a large upfront infrastructure that's necessary for enterprise companies, but it's kind of a harder chicken and the egg. Consumer is easier. Like there's some companies you can just, even B2B, you can you can sell something before you build it. It's relatively simple. There's like market dynamics or marketplace dynamics where the more people to use it, the more valuable. But this case, it's just, raw horsepower to build what you needed to build.
Yeah. And I think the thing we had that gave us conviction is the thesis was so clear. Again, we still don't know what the ultimate adoption is going to be and the timing and the cadence and all of these kinds of things. But I think it's really hard to imagine or say the world where pay by bank is not a meaningful share of digital payments in the United States in 10 years. Whether that means it's 5 or 20, I can't tell you. But that, we fundamentally believe. The other piece is the value prop of the product is so clear. Every time we talk, 90+% of merchants we get intro to, they want to have a conversation with us because we say, hey, are you interested in saving 80% on your cost of payment processing? And they usually say, that sounds interesting.
Yeah.
Let's dive into the details. Who are you guys? Does this make sense for us? But that's at least interesting enough to get a conversation. And having such a clear and compelling value prop is very, very rare, often in B2B sales or SaaS or even payments. It's more like ours is better than the competition, we think, or we're selling you this new thing. It's going to help you in some other way. It's not like we save you 80% on your payments.
And they can use,
that's it. So
sorry to interrupt you. Can they use credit cards concurrently or would they have to give up credit card acceptance?
No. So they just add that as a payment option.
Yeah.
They'll pay credit card, pay by bank, PayPal, and whatever. So it's just an additional option. And the more volume they drive to it, the more money they save. And so because of that, because the risk reward for the merchant is so good and the value prop is so clear, we were able to have conviction, even though it took a while to get actual traction after we built the product. And then you have a long enterprise payment sales cycle. But the beauty is once you're on the other side of that, enterprise payments tends to be a pretty decent business.
Yeah.
And so, it tends to be stickier and higher quality, but it's not easy. It's a long time to build. And the sales cycle, the reality is just, enterprise sales is
it has a reputation for a reason. Eric, this has been a lot of fun. I really enjoyed hearing your thoughts on the market and diving deep into the ways that people invest and why they invest and nuances there, and then what you're doing at Link Money. So thanks for coming on. Are you active online? Are you writing, tweeting, anything you want to throw out personally?
I have a LinkedIn. I post once in a while, not that often, but follow me on LinkedIn. I have a Twitter. That's kind of low key. I don't tweet. I've never tweeted, but I actively follow and read.
Oh, cool. Sweet, man. Well, thanks again and good luck with everything. I hope you guys keep crushing it.
Appreciate it. Thanks for having me.